Welcome to the Gamma Brief by Gexlog.com. I am your host, Alex. Here, we don't trade the headlines, we trade the structure. Every morning, we strip down the market mechanics, gamma exposure, dealer flows, and volatility regimes, so you can trade the math, not the noise. As always, this is market intelligence, not financial advice. Now let's get into the levels. February 12th, 2026, ES futures are trading at 69.80. We are in a negative gamma regime with the VIX holding firm above 17. Volatility compression is failing, and if the 69.24 gives way, the dealer bid disappears. Let's assess the regime. We are operating in negative gamma. Dealers are short gamma here. That means they are amplifying volatility, not suppressing it. When the market drops, they sell to hedge. When it rallies, they chase. This creates a slippery price action and liquidity gaps. The VIX at 17.43 isn't panic yet, but it signals that the buy the dip mechanic is broken. We have a trend up forecast today, but do not mistake a trend day for safety. In negative gamma, a trend can reverse violently if structural supports fail. Here are your critical pivots. The neutral zone is effectively 69.73 to 69.80. We need to hold this to sustain any morning bid. Your upside pivot is the call wall at 7,000. This is a massive resistance block. A break above 7,000 forces a short squeeze, but until then, it is a ceiling. Your downside pivot, the trapdoor, is 69.24, lining up with support 1. Below that, we have an air pocket down to 69.06. If the 69.24 fails, acceleration is the base case. Looking at the overnight session, the reflation narrative is back in the driver's seat. First, the hangover from the strong January NFP report is still forcing a repricing of Fed cut probabilities, pushing yields higher and tightening financial conditions. Second, we saw a 55 basis point gap overnight on modest volume, confirming that liquidity is thin and participants are nervous about higher for longer rates. The market is struggling to accept these higher valuations against a backdrop of strengthening yields. On the risk radar today, the board is lit up at 8:30 a.m. Eastern. We have a barrage of data, PPI, core PPI, and jobless claims all hitting the wire simultaneously. This is a high variance window. The asymmetric risk here is a hot PPI combined with low jobless claims. That reinforces the sticky inflation thesis and could trigger a bond sell-off that drags equities down through the 69.24 trapdoor. Conversely, soft data could spark a relief rally into the 7,000 call wall, but conviction will be low. Watch the reaction in the first 15-minute post-release. Strategic implications are clear. This is not an income environment. Do not sell Iron Condors here. The negative gamma whipsaw will destroy your wings. Focus on convexity. If we hold the 69.73 long call, or call spreads targeting 7,000 makes sense. If we lose 69.24, switch to long puts or put spreads to capture the acceleration. Respect the trend up forecast, but keep your stops tight. The bottom line, we are squeezed between a rising trend forecast and a fragile negative gamma structure. The trigger is the 8:30 a.m. data dump. Expect expansion, not compression. The regime wants to move. Position for a break or stay small. Level set, bias defined. Good luck out there. If this data helps you see the board more clearly, hit that subscribe button to keep the Gamma Brief in your daily rotation. For the full dashboard, head over to Gexlog.com. As a reminder, this briefing is for informational purposes only. I am not a financial advisor, and nothing here constitutes investment advice. Derivatives trading involves high risk and is not suitable for everyone. trade your own plan.